Tom Lee just issued a warning to investors: don't make this mistake right now. The Fundstrat head of research recently joined CNBC's Closing Bell to discuss the recent sell-off in technology stocks, what's really happening with semiconductor shares, the impact of the highly anticipated SpaceX IPO, and why he believes the market may be about to surprise a lot of people. According to Tom Lee, many investors could be misreading the current market weakness, and he argues that this may not be the market top that so many people are expecting. In this video, I'll show you Tom Lee's interview uninterrupted, and afterward, I'll break down exactly what he said, what it means for investors, and whether I agree with his outlook for the market. Then I'll give you my in-depth analysis of two dirt-cheap stocks that could be worth buying right now. Let's hear what Tom Lee has to say.
Let's welcome in Tom Lee. He's Fundstrat's managing partner and head of research. Good to have you. You look at this market and you think what?
Well, Scott, I think the market, of course, is showing a lot of signs of jitters to me. The jitters in front of the SpaceX IPO and also just consolidating all these gains. Plus, we know there's a lot of future capital that's going to be raised by Google, Meta, OpenAI, and Anthropic. So I think the market's trying to sort of price all this in front of the SpaceX IPO, which is this Friday. I think it's healthy, though, and I don't think it's actually going to derail the tech trade either.
Well, what's happening in the chip stocks? Are they the ones where you think there's been the selling as most related to positioning ahead of the IPO that's coming later this week in SpaceX? How would you assess what's happened there?
Yeah, that's right, Scott. I mean, SpaceX is a $75 billion IPO, and because of its index inclusion into the NASDAQ 100, a lot of institutional funds are now going to have to raise funds to not only buy the IPO, but then to have cash available to actually position size, because they don't know if it's 4 times oversubscribed, they'll only get 25% of their allocation. But then to get a full market weight position, they're going to have to buy a lot in the aftermarket. I think that cash means selling some of the recent winners. I'd say the good sign, though, is that the memory stocks held above the Friday lows, and same thing with the semis. So I think that there's basically gut punches being seen there, but I don't think it means that those charts are completely broken.
Does the market need SpaceX to trade well in its debut?
Yeah, I think it is important, Scott. We expect it to trade well because it's an important company, and the Elon Musk himself is an N of one person, but there's also a pretty good roadmap for why there's a future growth and a very big addressable market. If it trades poorly, I think it's going to give credence to a lot of the skeptics who say, well, the market's topping, and this marks the top. I'm kind of going to lean against that because I've been hearing a lot of folks declaring the top is in. So I'd say as a contrarian, because so many people think SpaceX marks the top, it's probably not the top.
You think the uptrend is still intact, to be led by tech?
That's right, Scott. I do. I think that this is a dip that's going to be bought. As you know, we still expect this to be a 3-phase market this year where we have a strong uptrend. I think that continues for the foreseeable future. I do think there's a pullback later this year. I think it's closer to lockup expiry and that overhang. And overall, I do think it's tracking the way we thought, which is 2026 would be a tough year, but overall a good year.
But you're still looking for some Fed-related turbulence or volatility as well. You were talking about that more as a reason why the market would have a pullback more so than lockup expirations for some of these big IPOs. Have you changed your thought process there?
Scott, I think it is 3 parts that create that second part drawdown. One is the Fed, the market testing this new Fed chair, Kevin Warsh. I mean, he's going to make his debut this week, but it is really going to be testing his ideas of how to measure inflation and his path forward, and especially in the face of what might be policy that he pursues that is not in sync with the White House expectations. The second is, I think, the lockup expirations of all these large IPOs. I think that does represent supply. And the third factor, I think, is that as much as oil's sort of, the price has not risen as much as we expected, I do think there's going to be shortages developing later this year that the market's going to grapple with.
What stood out to me immediately was that Tom Lee is not dismissing the weakness we're seeing. He openly acknowledges that the market is nervous. Investors are dealing with uncertainty surrounding the massive space IPO, concerns about future capital raises from some of the biggest technology companies in the world, and the reality that markets rarely move straight up without taking a breather. According to Lee, the market is essentially experiencing a case of short-term jitters. After a powerful rally, investors are trying to digest gains while simultaneously preparing for one of the most anticipated public offerings in recent memory. Rather than viewing the recent pullback as a sign of fundamental weakness, he sees it as a natural part of the market's process. I actually think this is an important distinction. Many investors automatically assume that whenever technology stocks decline sharply, something must be broken beneath the surface. But markets are often more mechanical than emotional. Sometimes stocks fall simply because large institutional investors need cash for another opportunity, not because the business outlook has suddenly changed. That brings us to the core of Lee's argument. He believes a significant portion of the recent selling pressure is directly connected to the upcoming space IPO. According to him, this is not just another IPO, this is a massive event. He notes that the deal is expected to be around $75 billion in size, and that its inclusion into major indexes like the NASDAQ 100 will force institutional investors to participate. This creates an interesting chain reaction. Large funds need capital available for the IPO allocation, but they also need additional cash because they don't know how many shares they'll actually receive. If demand ends up being several times greater than available supply, investors might only receive a fraction of what they requested. That means they must have enough cash ready to buy more shares later in the open market. Where does that cash come from? Often it comes from selling existing positions. And what positions do institutions typically sell first? Usually the stocks that have recently performed the best. This is where Lee connects the dots to the weakness we've been seeing in semiconductors and other high-flying technology names. His view is that investors are trimming winners to raise capital for the space IPO rather than abandoning the broader AI and technology investment thesis. I think this explanation makes a lot of sense. When investors see semiconductor stocks suddenly drop 3%, 4%, or even 5%, the immediate reaction is to assume that demand is collapsing or that AI spending is slowing. But sometimes there is a much simpler explanation. Large institutions managing billions of dollars need liquidity, and they often raise that liquidity from the most profitable parts of their portfolios. Lee also points to something technical that gives him confidence. He notes that many of the memory stocks and semiconductor names managed to hold above their previous lows. That might sound like a small detail, but technical analysts pay close attention to these levels. If a stock breaks below a major support area, it can signal that buyers are losing conviction. When support levels hold despite heavy selling pressure, it suggests that long-term investors are still willing to step in and buy. In Lee's words, these stocks may have taken a gut punch, but their charts are not broken. That is an important message because there is a big difference between a temporary correction and a genuine trend reversal. The conversation then shifted to perhaps the most interesting question of the entire interview. Does the market actually need the space IPO to succeed? Tom Lee's answer was yes. He believes the IPO is important because it represents much more than a single company going public. It has become a symbol of investor appetite for innovation, growth, and future technologies. Lee points to the enormous addressable market and the growth opportunities ahead. He also highlights the unique role Elon Musk plays in attracting investor attention and confidence. If the IPO performs well, it would reinforce the idea that investors remain willing to pay premium valuations for companies with strong growth prospects. If the IPO struggles, however, it could strengthen the arguments of market skeptics who already believe stocks have gone too far too fast. This is where Lee's contrarian mindset becomes very interesting. He says he has heard countless people claim that this IPO will mark the top of the market. Historically, whenever an event becomes universally accepted as the signal for a market peak, it often fails to become that signal. Markets have a habit of frustrating the largest number of people possible. When everyone expects one outcome, the opposite often happens. Lee essentially argues that because so many investors already believe this IPO marks the end of the rally, the odds increase that it actually won't. Personally, I find that argument surprisingly compelling. Market tops rarely arrive with advance warning labels attached to them. If every investor is watching the same event and expecting the same result, markets often find a way to surprise them. That does not mean the IPO is guaranteed to succeed. It simply means investors should be cautious about following popular narratives without questioning them. Another major takeaway from this interview is that Lee remains firmly bullish on technology. Despite all the recent volatility, despite the selling pressure, and despite growing concerns about valuations, he still believes the broader uptrend remains intact. He expects investors to buy this dip. This has been one of the defining characteristics of the current bull market. Every meaningful pullback has eventually attracted buyers who view weakness as an opportunity rather than a reason to panic. Lee continues to view 2026 as a three-phase market. The first phase is the strong uptrend that investors have largely experienced already. The second phase is a more meaningful pullback later in the year. The third phase would likely involve a recovery after that correction. What's notable is that he has not changed his overall roadmap despite recent market turbulence. He still believes the year could be challenging at times, but ultimately positive. That kind of consistency matters. One of the biggest mistakes investors make is constantly changing their outlook every time the market moves a few percentage points. Lee appears focused on the bigger picture rather than reacting emotionally to short-term volatility. The discussion then moved toward the factors that could eventually trigger the larger correction he expects later this year, and this is where things become particularly interesting. The first risk involves the Federal Reserve. Lee specifically mentions new Fed Chair Kevin Warsh and the possibility that investors will begin testing his approach to monetary policy. Whenever leadership changes at the Federal Reserve, uncertainty increases. Markets spend years adapting to one style of communication and decision-making. When a new chair takes over, investors must learn how that person interprets inflation, employment data, economic growth, and financial conditions. Lee believes investors will closely scrutinize Warsh's inflation framework and his path forward for interest rates. What makes this especially important is the possibility that his policy preferences may not perfectly align with expectations coming from the White House. Markets generally dislike uncertainty. When investors are unsure whether monetary policy and political priorities are moving in the same direction, volatility often increases. The second risk factor Lee identifies involves lockup expirations. For investors unfamiliar with the concept, lockups prevent insiders from selling shares immediately after an IPO. Eventually, those restrictions expire. When they do, millions of additional shares can suddenly become eligible for sale. Lee believes that the wave of upcoming lockup expirations from large IPOs could create significant supply in the market. Even if the underlying businesses remain strong, increased share supply can place temporary pressure on stock prices. This is one of those factors that many retail investors overlook. Everyone focuses on earnings, revenue growth, and valuation metrics. But supply and demand dynamics matter too. Sometimes a stock declines not because the company is performing poorly, but because more shares are entering the market. Overall, what I took away from this interview is that Tom Lee remains constructive on the technology sector and the broader market despite the recent turbulence. He views the current weakness as largely driven by positioning ahead of the space IPO rather than a collapse in the AI investment story. He believes semiconductor stocks have suffered temporary damage rather than permanent damage. He expects the space IPO to play an important psychological role for investors. He remains confident that the broader uptrend is still intact. At the same time, he is not ignoring future risks. He recognizes that Federal Reserve policy, lockup expirations, and other market forces could create a more significant pullback later in the year. For me, the most important lesson is that investors should separate short-term noise from long-term trends. Markets are always searching for reasons to worry. There will always be another headline, another correction, or another event that appears scary in the moment. The challenge is determining whether those events actually change the long-term investment thesis, and based on Tom Lee's analysis, he believes they do not. He sees a market that is consolidating gains, absorbing a major IPO, and preparing for the next stage of the cycle rather than entering the beginning of a prolonged downturn. Now let's dive in and talk about two dirt-cheap stocks you can buy right now that could potentially deliver massive long-term returns for patient investors. Let's start with the first stock on the list, SiriusXM, ticker symbol SIRI. Sometimes the best investments are not the companies everyone is talking about. They're the companies everyone has stopped talking about. Think about it. When was the last time you heard investors excitedly discussing satellite radio? Probably not recently. Most conversations today revolve around artificial intelligence, cloud computing, robotics, and the latest technological breakthroughs. Meanwhile, SiriusXM has quietly become one of the most ignored media stocks on the market, and that might be exactly why value investors should pay attention. Before looking at any financial metrics, it's important to understand why this business still matters. SiriusXM occupies a unique position in the entertainment industry. If someone wants premium satellite radio service in North America, there is essentially only one major option. SiriusXM has dominated this niche ever since the combination of the only two satellite radio providers nearly 2 decades ago. That kind of market position is rare. Many businesses fight endless competitive battles. SiriusXM largely owns its category, and while that category may not be growing at explosive rates, it remains highly profitable. Today, SiriusXM serves approximately 33 million subscribers. That's a massive audience. Millions of drivers continue paying monthly subscriptions for access to commercial-free music, sports programming, news coverage, talk radio, comedy channels, and exclusive content. Now, critics will immediately point out that consumer habits have changed. And they're right. Younger consumers have more entertainment choices than ever before. Connected vehicles have become increasingly common. Streaming services continue competing for listeners' attention. Podcasts are everywhere. Digital media consumption continues evolving. Those realities have created challenges for SiriusXM. There is no point pretending otherwise. Over the last several years, revenue growth has been difficult to achieve. In fact, the company experienced roughly 3 years of modest revenue declines. For many investors, that was enough reason to move on. But investing often becomes interesting when the narrative starts changing, and that's exactly what appears to be happening here. After several years of declining revenue, SiriusXM has now reported back-to-back quarters of year-over-year revenue growth. The growth has been small, nobody is calling it explosive, nobody is claiming the company has suddenly become a hyper-growth stock. But that's not the point. The point is stabilization. When a business transitions from shrinking to growing, even modestly, investor perception can change dramatically. Especially when expectations are already extremely low, that's one of the biggest opportunities in investing. Finding situations where the future simply turns out better than people expect. And right now, many investors seem to expect very little from SiriusXM. That's where the valuation story becomes so compelling. Even during periods when revenue was moving in the wrong direction, SiriusXM continued generating enormous amounts of cash. The company has consistently produced more than $1 billion annually in free cash flow. Think about what that means. This isn't a struggling business desperately trying to survive. This is a company generating over $1 billion in excess cash after covering operating expenses and capital investments. Free cash flow is often the lifeblood of shareholder returns. Companies that generate significant free cash flow have options. They can reduce debt, they can invest in future growth opportunities, they can buy back stock, and they can reward shareholders through dividends. SiriusXM has been doing exactly that. The company has spent years aggressively returning capital to shareholders. Its stock buyback program has reduced share count and enhanced shareholder value over time. At the same time, investors continue receiving a sizable dividend. Currently, SiriusXM offers a dividend yield approaching 4%. In today's market, that's a meaningful source of income. And here's why that matters. Many investors focus entirely on stock price appreciation. But long-term wealth creation often comes from a combination of capital gains and dividend income. When a company generates strong cash flow and returns a portion of that cash directly to shareholders, investors benefit even during periods when stock prices remain relatively flat. You're effectively getting paid while you wait for the market to recognize the company's value. That can be a powerful advantage. Now let's talk about what may be the most attractive part of the entire investment thesis. Valuation. SiriusXM currently trades for less than 9 times forward earnings. Less than 9. Take a moment to think about that. This is a company with millions of paying subscribers, recurring revenue streams, strong free cash flow generation, an established brand, and a dominant position within its niche. Yet the market values it at a single-digit earnings multiple. Why? Because investors remain worried about long-term growth prospects. The market sees challenges. The market sees slowing subscriber growth. The market sees changing consumer preferences. But what if those concerns have already been fully reflected in the stock price? That's the question investors need to ask themselves. Because if the business simply stabilizes and continues generating strong cash flow, today's valuation may look extremely attractive in hindsight. One of the most important concepts in investing is understanding the difference between a bad business and a good business facing temporary skepticism. The market often treats those two situations the same way, but they're very different. A bad business destroys value. A good business experiencing skepticism can create opportunity, and I believe SiriusXM falls much closer to the second category. There's another factor that makes this story even more interesting. One of the world's most successful investment organizations has been steadily increasing its ownership position. Over the past several years, Berkshire Hathaway has continued building its stake in SiriusXM. The firm now owns more than 37% of the company. That ownership level is significant. Now, nobody should buy a stock simply because a famous investor owns it. That would be a mistake. Every investor should conduct their own analysis. But it's worth asking why sophisticated investors continue accumulating shares. When experienced value investors see a company with recurring revenue, strong free cash flow, shareholder-friendly capital allocation, and a depressed valuation, they often see opportunity where others see risk. Personally, I think that's one of the most overlooked aspects of the SiriusXM story. Many investors are focused entirely on what the company isn't. They're focused on what it used to be. They're focused on the growth rates of the past. Meanwhile, value investors are looking at what the company actually is today. A highly profitable subscription business generating substantial cash flow. Those are two completely different perspectives. Of course, every investment comes with risks. The media landscape continues evolving rapidly. Consumer habits can change. Competition for listener attention remains intense. Economic conditions can impact consumer spending. Higher gas prices could influence driving habits. Consumer confidence can fluctuate. These factors matter. But here's what makes investing fascinating. Stock prices already incorporate expectations. Investors aren't paying premium valuations for SiriusXM. They're paying a valuation that reflects considerable skepticism. And when expectations become too negative, even small improvements can produce meaningful stock returns. Imagine a scenario where revenue continues stabilizing. Imagine free cash flow remains above $1 billion annually. Imagine management continues buying back shares. Imagine the dividend continues rewarding shareholders. And imagine the market eventually decides the company deserves a slightly higher valuation multiple. You don't need extraordinary growth for shareholders to generate attractive returns under that scenario. You simply need a good business trading at a reasonable price. And that's exactly why SiriusXM earns a spot on this list of dirt-cheap stocks. It has a dominant market position, 33 million subscribers, strong recurring revenue, more than $1 billion in annual free cash flow, an attractive dividend yield, shareholder-friendly capital allocation, and a valuation that appears disconnected from the company's ability to generate cash. Will it double overnight? Probably not. Will it become the next market darling? Probably not. But great investments aren't always flashy. Sometimes they're boring businesses quietly generating profits while investors look elsewhere. And sometimes those are the investments that end up producing surprisingly strong long-term returns. That's why SiriusXM deserves serious consideration from value investors willing to look beyond the headlines and focus on fundamentals. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's move on to the second stock on today's list, Royal Caribbean, ticker symbol RCL. This is probably the stock that will surprise the most people. When many investors hear the word cruise line, they immediately think of a highly cyclical business that rises and falls with the economy. They assume that travel spending is unpredictable. They assume vacations are among the first things consumers cut when economic uncertainty appears. And because of those assumptions, cruise stocks have often traded at lower valuations than many other consumer discretionary businesses. But what if investors are overlooking one of the most powerful growth stories in the travel industry? That's exactly why Royal Caribbean deserves a closer look. Before we talk about earnings, valuation, or future growth projections, let's first understand why this business matters. At its core, Royal Caribbean operates in one of the most emotionally driven industries on the planet. People don't book vacations because they need them. They book vacations because they want experiences, they want memories, they want adventure, they want to spend time with family and friends. And unlike many consumer purchases that lose their appeal over time, travel experiences often become even more valuable in people's minds long after the trip is over. That's an incredibly powerful dynamic. experiences tend to be far more resilient than many investors realize. And within the travel industry, cruising occupies a particularly attractive position. Here's why. Cruises continue offering one of the best overall values in travel. When someone books a cruise vacation, they're not simply purchasing transportation, they're getting accommodations, dining, entertainment, activities, and access to multiple destinations all bundled into one package. For many travelers, especially families, that convenience is difficult to match. And despite the growing popularity of cruising, the industry still represents a surprisingly small portion of the overall travel market. In fact, cruise lines account for only about 2% of the global travel and tourism industry. Think about that for a second. Just 2%. That means the industry still has a massive runway for growth. Even modest increases in cruise adoption could create substantial long-term opportunities for the companies operating in the space. And when it comes to capturing that opportunity, Royal Caribbean stands out from the competition. Among the major cruise operators, Royal Caribbean has established itself as one of the industry's strongest performers. The company has consistently demonstrated superior growth and stronger operating margins. That's important because growth by itself is not enough. Any company can grow revenue if it's willing to sacrifice profitability. The real challenge is growing while maintaining healthy margins. Royal Caribbean has shown an ability to do both. That's one of the reasons the stock commands a premium valuation relative to many other companies in the cruise industry. And interestingly, even that premium valuation still looks surprisingly reasonable. Royal Caribbean currently trades at roughly 15.7 times forward earnings. Now, in some sectors, a forward earnings multiple around 16 might look average. But for a company producing double-digit growth with strong demand trends and expanding profitability, that valuation starts looking quite attractive, especially when investors compare it to many popular growth stocks trading at significantly higher multiples. The market often rewards businesses that can grow earnings consistently over long periods, and Royal Caribbean appears positioned to do exactly that. The company expects both revenue and earnings to increase approximately 11% this year. That's impressive, not because it's explosive growth, but because it's sustainable growth. Investors often become obsessed with companies growing 30%, 40%, or even 50% annually. The problem is that those growth rates rarely last forever. Sustainable double-digit growth combined with strong profitability can actually be a more attractive formula for long-term investors. And so far, the demand picture remains encouraging. Bookings have continued to show strength. Consumers are still demonstrating a willingness to spend on travel experiences despite ongoing economic uncertainties. That's a very important signal. When people continue prioritizing vacations even during periods of economic concern, it suggests the underlying demand is stronger than many investors expected. Personally, I think this is one of the most underestimated trends in the market today. For years, investors have worried about consumer weakness, yet time and time again, people continue finding room in their budgets for experiences that matter to them. Travel remains near the top of that list, and Royal Caribbean is benefiting from that reality. Another reason I find this stock interesting is because of the company's ability to differentiate itself. In highly competitive industries, companies often struggle to build lasting advantages. But Royal Caribbean has spent years investing in larger ships, unique onboard experiences, premium amenities, and destination offerings designed to attract repeat customers. That matters because repeat customers are incredibly valuable. A traveler who enjoys their first cruise is far more likely to book another one in the future. And once consumers become comfortable with the cruising experience, many begin viewing it as a preferred vacation option rather than an occasional novelty. That creates a powerful cycle. Strong customer experiences drive repeat bookings. Repeat bookings improve occupancy levels. Higher occupancy supports profitability, and stronger profitability creates resources for future investments. That's exactly the type of business model long-term investors should pay attention to. Now let's talk about dividends. While Royal Caribbean is primarily a growth story, shareholders are also receiving income. The company recently increased its quarterly dividend and currently offers a yield of approximately 1.8%. No, that's not the highest dividend on today's list, but the fact that management is increasing shareholder returns while simultaneously investing in future growth is a positive sign. It reflects confidence in the company's financial position and long-term outlook. And when you combine dividend growth with earnings growth, investors can potentially benefit from multiple drivers of shareholder value creation. Of course, no investment is without risks. Travel spending can be affected by economic downturns. Fuel costs can fluctuate. Geopolitical events can influence travel demand. Weather disruptions can impact operations. Those risks are real. But here's the key question. Are those risks already reflected in the stock price? At around 15.7 times forward earnings, investors are not paying an extreme valuation. In fact, many would argue they're paying a very reasonable price for a company expected to grow both revenue and earnings at double-digit rates. That's what makes Royal Caribbean so compelling. You're not buying a mature company with stagnant growth, and you're not paying a sky-high multiple for future potential. Instead, you're getting a business that has already proven its ability to execute, continues benefiting from favorable industry trends, and still appears attractively valued relative to its growth prospects. To me, that's a very appealing combination. Strong demand, strong execution, industry leadership, double-digit growth, rising earnings, shareholder returns, and a valuation that still leaves room for upside. If the cruising industry continues expanding its share of the global travel market over the next decade, Royal Caribbean could be one of the biggest beneficiaries. And if that happens, today's valuation may eventually look like a bargain. That's why Royal Caribbean earns its place as the second dirt cheap stock on this list. Before we move on to our third and final stock, I want to thank today's sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial futures. So let's quickly recap. SiriusXM offers a dominant position in satellite radio, a massive subscriber base, strong free cash flow generation, and a valuation below 9 times forward earnings. Royal Caribbean combines industry leadership, double-digit growth expectations, rising profitability, and continued strength in travel demand while trading at a surprisingly reasonable valuation. Each company operates in a completely different industry, each has different risks, each has different growth drivers, but they both share one important characteristic: they appear significantly cheaper than many of the stocks investors are chasing today. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd love to hear from you. Which of these three companies do you think has the strongest long-term competitive advantage? SiriusXM with its subscription-based media platform, Royal Caribbean with its leadership position in the growing cruise industry, or Upbound with its diversified lease-to-own and financial technology ecosystem? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.